You're about to hand over a massive fortune of your hard-earned wealth to the taxman. And the worst part is, you don't even realize it's happening right now. If you've got over $300,000 sitting inside your accounts, you're bleeding cash before the 30th of June deadline hits. Welcome back to Aussie Super Secrets. Today, we're breaking down the ultimate institutional blueprint to shield over $50,000 from the ATO before this financial year permanently closes. I'll reveal a hidden loophole that's saving wealthy Australians a fortune this week. But remember, this is educational information only. You've got to move fast because the countdown to EOFY is officially active and time's running out for your balances. We aren't here to play games. We're here to protect what's yours from unnecessary erosion. Let's talk about the absolute foundation of high net worth tax destruction. The ATO has set strict rules, but if you play them perfectly, the rewards are substantial. The first major concept you must master is maximizing your concessional contributions. For the 2025-26 financial year, the annual cap is exactly $30,000. Many corporate executives think their employer's standard contributions cover this completely, but they're completely wrong. Your employer only pays the statutory minimum, leaving a massive gap that you can fill yourself to slash your taxable personal income. Let's look at the official tax environment, because numbers never lie when it comes to high net worth wealth preservation. If you're earning a high corporate salary or managing substantial administrative operations, every single dollar over the threshold is highly vulnerable to heavy tax rates. General information only, does not constitute personal financial, taxation, or legal advice. By setting up a strategic salary sacrifice arrangement with your payroll department, or by making personal deductible contributions directly from your bank account, you instantly lower your tax bracket liability. Think about it. If you're earning $180,000 a year, your marginal tax rate is a heavy 30% plus the Medicare levy. Every extra dollar you earn is heavily taxed. But when you redirect that money into your superannuation fund, it's only taxed at a concessional rate of 15% inside the fund. That's an immediate estimated saving of thousands of dollars put back into your pocket. It's legal, it's highly efficient, and it's the exact mechanism the top 1% use to compound their wealth seamlessly over time. If you're neglecting this strategy, you're essentially leaving a massive tip for the government that they don't deserve. But you can't just throw money blindly into the system without understanding the strict timing thresholds. The ATO doesn't care when you hit the transfer button on your banking app. They only care when the cash actually clears into your fund's ledger. This brings us to the core differences between how large industry funds and commercial retail funds process your end-of-year wealth injections. Industry funds often have massive processing backlogs during June, because millions of Australians are rushing at the final minute. If your contribution lands on the 1st of July instead of the 30th of June, your deduction is completely disqualified for this financial year. You'll lose the entire tax benefit instantly. Stop right there. This is a critical alert. If you've been blindsided by an unexpected tax bill before, or if you're terrified of losing your hard-earned wealth this June, comment your financial pain right below this video right now. Let me know if your current fund is letting you down. Let's keep pushing deeper into the institutional matrix because it gets much more dangerous for high earners. We need to talk about an aggressive tax hit known as Division 293. If your combined income and concessional super contributions exceed the threshold of $250,000, the ATO triggers an extra 15% tax on your contributions. It's a brutal double taxation trap that catches thousands of successful corporate professionals by surprise every single year. It means your contributions are taxed at 30% total instead of 15%. But don't panic, because an experienced financial advisor knows there's still an estimated net advantage. Compared to paying the top marginal tax rate of 45% plus levies. You must calculate your position with absolute precision before the EOFY deadline arrives to avoid unnecessary penalties. Now, let's uncover the most terrifying operational hazard in the entire Australian financial landscape. I call it the BPI death trap. This single operational oversight destroys thousands of valid tax deductions every single June. When you make a personal deductible contribution using a standard BPAY code provided by your industry funds or retail funds, that transaction does not clear instantly. It requires multiple business days to move through the interbank clearance systems. If you initiate your BPAY transfer on the 28th of June, thinking you're safe, you're walking straight into disaster. The funds will likely not be officially registered by your trustee until early July. Boom! Your deduction is wiped out for this year. Your concessional cap for next year is accidentally consumed. And you're left with a massive, unexpected tax bill that you can't escape. It's an absolute nightmare for wealth management continuity. To completely bypass the BPI death trap, you must contact your fund immediately to find out their exact internal cutoff dates, or utilize real-time electronic transfer methods if they support them. Never leave your wealth at the mercy of banking delays during the final week of June. General information only does not constitute personal financial, taxation, or legal advice. You've also got to ensure you lodge a valid notice of intent to claim a tax deduction with your fund trustee before you file your EOFY tax return. If you lodge your tax return with the ATO before receiving the formal acknowledgement letter from your super fund, the entire deduction is permanently canceled. It's a rigid, non-negotiable process rule that catches out self-directed wealth builders constantly. Wealth management is all about executing these small administrative steps with absolute institutional discipline. Here is the absolute goldmine strategy that can unlock an estimated $50,000 or more in immediate deductions right now. It's called the Carry Forward Concessional Framework. If your total superannuation balance was below $500,000 on 30th June of the previous financial year, you're legally allowed to claw back unused concessional cap amounts from the past 5 years. This means if you haven't been maximizing your caps recently, you could potentially deposit a massive lump sum of $50,000 or even $100,000 this week. Imagine wiping out a massive chunk of your taxable income in a single stroke. It's the most powerful wealth-building weapon available to Australians over 45 who are entering their peak earning years. Don't let administrative laziness destroy your retirement trajectory this year. Take action today, check your caps, and secure your wealth before time runs out. This is general educational information only, so make sure you consult a qualified specialist to review your exact situation before moving large tranches of capital. If you want to stop bleeding cash to institutional fees and want to protect your hard-earned assets from unnecessary taxation burdens, make sure you hit that subscribe button to Aussie Super Secrets right now. We'll see you in the next strategy briefing. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets, all rights reserved.